U.S. natural gas futures slipped toward $3.30 on Friday but still posted an impressive 10% gain for the week. The rally was driven by rising LNG exports and colder weather forecasts, both of which are expected to fuel higher heating demand. Gas flows to LNG export terminals rose to 15.1 billion cubic feet per day in early February, up from 14.6 in January, approaching December's record highs. Looking ahead, meteorologists project colder than normal temperatures through February 22, which should help sustain strong demand. Meanwhile, natural gas inventories are expected to drop by 597 BCF over the 4-week period from February 1 to February 28, an 83 billion cubic feet larger decline than the 5-year average, signaling a bullish trend. If this projection holds, storage levels would fall to 1,800 BCF, widening the current storage deficit against the 5-year average from -93 to -176 BCF. On the supply side, natural gas production in the United States has increased to 106.1 billion cubic feet per day from 102.7 in January, though daily output is expected to dip slightly. This is a critical indicator, as traders generally focus more on production trends than short-term demand fluctuations. While gas consumption can shift rapidly due to seasonal and weather-related factors, production follows a longer trajectory, shaped by investment decisions and strategic planning by producers. Since ramping up or reducing output isn't an overnight process, changes in production often reflect broader industry trends and future supply dynamics. If no major geopolitical disruptions arise this year, rising production will likely exert downward pressure on prices, keeping them within a sustainable range for producers, most likely between $2.70 and $3. Meanwhile, the U.S. gas rig count, a key forward-looking measure of production growth, ticked up by 2 this week to reach 100. While this suggests producers may be responding to higher prices and stronger seasonal demand, the count remains well below historical levels, signaling that any significant increase in output could take time to materialize. In the short term, natural gas prices face downward pressure from weak demand and technical resistance. On the downside, support is emerging near the 100-day moving average, with last week's low at $3 acting as a key level. A break below this support could trigger further declines, especially if the market perceives storage levels as adequate despite recent withdrawals. However, the anticipated rise in heating demand in the coming weeks introduces upside risks, particularly if storage withdrawals accelerate. A push above $3.45 could attract fresh buying, especially if updated forecasts extend the colder trend into late February. Please like, subscribe, and comment to support the channel. See you in the next one.